first half of 2015, investors pulled $22 billion out of large-cap core U.S. equity mutual funds, but added $19 billion to S&P 500 index-linked mutual funds. During this live streaming webinar, we plan to highlight some data that helps explain these trends and how you can use ETFs and mutual fund research to build your portfolios.
Small cap is, again, an asset class that is perceived to be best accessed via active management because there is inefficiency, there's a lot of mispricing, and active management is best to take advantage of that. And what we find with the data is consistently, whether you look at it over short term, near term, or intermediate term to long term, what you find is that a good chunk, in fact, sometimes as high as 80% or 90% of actively managed small cap managers they underperform the benchmark.
So if you can find a fund that has performed well, even kept pace with its benchmark, and has half the expense ratio of its peers, it's more likely to outperform its peer group. You get the benefits of active management, you save on the cost standpoint, but paying 1%, 1.5% for active management to then underperform the next year, it's really hard to justify. There tends to be very little, if not almost never, capital gains implications because the way an ETF is created and how the shares are swapped back and forth from one another. Whereas a mutual fund, if you are a holder of that mutual fund and management buys and sells stocks throughout the year, there's a good likelihood you're going to end up hit with a capital gains tax, even though you didn't do anything.